the last hours of the time you have here finishing your videos and comments have just started, but now you've got some time to sit back and just listen the wonderful talk that we have in the studio today. So no worries, you have got plenty of time left later. And for the talk today, welcome Luise in our studio. So nice to have you here. And we would like to invite you to join us, ask questions. For example, again, via Mobi, Event Mobi, just press the button, ask a question. And you can either come via video here, in case you want to be a part with your face. Or you can also just ask questions, write them, text them to us, and we will show them here in the studio. So no worries at all. And now I want to know about this Nobel Prize winning book, Luise. Can you tell us something about it?
Yes, so I think that's a very great book. It's called Good Economics for Hard Times. And as you've mentioned, it's actually not the book that won the Nobel Prize, but the two authors are Nobel Prize winning economists who got the Nobel Prize 2 years ago for their work towards alleviating global poverty using experimental methods. So I think that in itself already makes it a great fit for our hashtag social justice, right? Because alleviating global poverty is obviously an important part of it. But I think why I like this book and why I would really recommend it is that it also makes an effort to kind of save a bit the reputation of economists, right? And being an economist myself, obviously, I like that. And it does so by pointing out that most of the big issues of our times that we face today, like poverty, migration, trade wars, all these things are at its core economic problems, right? And why is this the case? I think they make a pretty convincing case that many of these things involve resource constraints. They involve making trade-offs and making choices, and ultimately also people who have different incentives and also conflicts of interests, right? And I think what they really show very well is that the job of economists today, or let's say where economists are the most useful to society, is actually not when it comes to just making recommendations or giving their conclusions about certain problems, but much rather by using data and experiments and gathering information and explaining to people, the costs and benefits of certain decisions and the trade-offs involved, and to equip them to make the best possible decisions individually and as societies. And I think that's really a great contribution of this book.
So thank you for sharing this tip with us.
Yes.
And last time you've brought cake into our studio. I chose Lebkuchen today because it's a little bit easier to share. And in case you want some Lebkuchen,
no,
you're
thanks.
fine. Okay,
good.
So then we're good to go. And I would say, let's start with our talk.
Yes. Okay, so I am excited that today we actually have Grace Blakeley here, who will talk to us about our, about our hashtag social justice. And Grace is an excellent fit for this because she's an English economics and politics commentator. She's a journalist and author of two very interesting books that actually fit our current topic, the whole topic of the opening week, but especially today's topic, very well. I've brought them with me also to make a little bit of marketing also for your books, Grace. The first one is actually about the financialization and the title is How to Save the World from It, right? So I'd be interested, Grace, perhaps we can start it off by talking about that, what it actually means that you see yourself as a democratic socialist, and also in this book come to the conclusion that democratic socialism is actually what's going to save us from financialization.
Yeah, well, thank you so much for having me today. It's a pleasure to be here. I'm joining you from a studio in London. I've had to position myself outside because I'm in a day of recording. So this was the space that they could find for me. But I think it's quite nice to join you from a kind of relatively leafy environment. So yeah, thank you for having me. I will also say that book, Stolen, is available now in German. Oh. I think it's published by Brumaire. So yeah, you can get that in German now, which is fantastic. And one other thing I wanted to say before I started my remarks, which perhaps slightly controversially, you were talking earlier about the Nobel Prize winners in economics. And it's worth pointing out, and I think maybe this will link into some of the things I'm going to say later, that there actually was never a Nobel Prize in economics. It was something that was developed much later as a kind of project between a bunch of quite neoliberal economists and the Swedish central bank. And the idea was to kind of really formalize this discipline of economics as a science, as something that was a kind of, a discipline through which would be able to establish and empirically verify truths, and that those truths could then be used to develop policy. And I think, especially given the way in which that kind of, the attempt to make economics into a science, which has manifested itself as the supremacy of particular kinds of economic modeling, and many of those models that failed to predict the financial crisis of 2008 and have given us potentially some pretty dodgy conclusions in the intervening period as well, that hasn't necessarily been a kind of progressive development, and that really kind of being able to accept that a lot of the choices that we make and that the way that our economies work has less to do with, rational utility maximizing agents, maximizing their utility subject to a budget constraint, and is much more about institutions, about social norms, about much kind of bigger and more social variables than what you might assume from just having economics as a science. And when it comes to these questions around financialization, money and banking and finance are generally, or they weren't historically, included in many of those big macroeconomic models that were built of the economy. So particularly in the run-up to the crisis of 2008, economists were very enamored with these things called dynamic stochastic general equilibrium models, where they believed that you could take the kind of micro foundations of economic interactions and piece those together into a much bigger macroeconomic model of how the whole economy would work. And one thing that they left out was the way that finance and money worked. And what we know is that for a number of different reasons, finance and lending and leverage and the kinds of behaviors and patterns of behaviors that you get in financial markets, they often generate instability and dynamics that pull us away from equilibrium rather than towards equilibrium. Hyman Minsky was one of the most famous economists who really looked into these dynamics and came up with this infamous quote that stability is destabilizing. He looked at all the ways in which stability in economics kind of degenerated into instability, and how you get financial crises after kind of moments of prosperity. The financial crisis of 2008 being the most famous one, where you had people like Prime Minister Gordon Brown saying boom and bust is dead, that all the kind of big problems of economics have now been solved and the only way is up, and then you get this massive crisis. So my book really looks at the kind of, I suppose, the institutional, social and political foundations that led up to that crisis of 2008, and what those things really tell us about the way that our society works. And basically, these are all questions of power. And I think that's why, again, this focus on economics as a science, that's what that misses out. It's questions of who has power in these interactions, in these economic interactions, and how that power shapes the way that society works and the way that institutions work. And the big argument of the book is really that from the kind of 1970s and 80s onwards, you had a big shift in most societies, where the balance of power between capital and labor, between bosses and workers, shifted in favor of the latter. And then within this subset of capital, you had an internal shift there whereby the power of finance capital became much greater. And this manifests itself, you can see this today in the data, in a falling wage share of national income, which is the case across most OECD economies, a rising profit share, and within that, a rising rentier or rentier share. So that's kind of profits accruing to financial institutions, but also owners of land, any kind of owners of resources that generate economic rents, i.e. kind of unproductive transfers of income from one group to another, finance being a good example, but also, as I said, kind of landlordism and those sorts of things. So the book really charts the way in which a small group of powerful economists was able to make the case for a shift towards a much more financialized model of the economy, one in which banks, landlords, rentiers would have much more power, and the way in which that reshaped our institutions, the way in which it reshaped our politics, society more generally, how that collapsed in the crisis of 2008, and then what's happened since then, and all the various different attempts that we've seen to try and revive that financialized model of growth, and why that's now coming up against its limits.
Right. So I think what is interesting about that is that you kind of paint this picture of how we see this massive redistribution of power that you just mentioned between workers and owners of capital, but now we're basically at a point where this opening week is devoted to a New Deal, and in Germany we recently had elections for parliament, so it's also perfect time for a New Deal. So really, what is it? What do you see as the solution to these problems? So how do you propose that we actually come up with a New Deal and change these issues?
Yeah, so I suppose there's really two ways of looking at this question. One would be the standard economists and policymakers way, which would be to say, well, we need to develop particular policies, and those policies will change the way that society works. They can be implemented from within the states, and that will, give us the solutions that we need to solve many of these problems. And so, you can think about, say, for example, the Green New Deal as a set of policies designed to decarbonize, create jobs, reduce inequality, and achieve a number of other goals. So, when you have the policies that are included in something along the lines of a Green New Deal, you're looking at, jobs creation programs, you're looking at large stimulus programs, but whereby that government spending is directed towards, say, investing in green infrastructure, decarbonizing our transport systems, doing things like retrofitting the housing stock. And alongside that, you might have changes to the financial system, for example. So things like both having a kind of a greater public mandate from within the finance sector, things like national investment banks that are able to kind of direct capital towards more environmentally sustainable projects, and then crowd in private capital to do that. You might also think about, changing the way that central banking is working. This is a live debate at the moment with the massive amounts of asset purchases that we've had from central banks. There's a very strong argument to say, well, central banks should be thinking about the assets that they're buying in terms of the carbon footprint of those corporations or institutions. And there's a lot of stuff that can be done at the fairly specific level when it comes to financial regulation to try and incentivize both investors and managers to try and make sure that they are operating according to these metrics as well. I think most of us can agree that the attempts to do that through things like ESG haven't been particularly successful. So there's certainly an argument for a more rigorous approach to financial regulation when it comes to decarbonization. So all of those things and many, many more, you can think of things like yeah, as I said, kind of jobs creation programs. There's a whole argument to suggest that the Green New Deal needs to be global. So it needs to encompass kind of resource and technology transfers to the global south, because the developing world is currently the place that's being hit most by climate breakdown. Lots and lots of stuff that comes under this broad heading of the Green New Deal. But I think we need to actually go one step further back, really, and think again about power. Because when, in my book, I talk about all the big changes that took place in the economy and in policymaking during the 1980s, when we saw this big shift away from a more kind of corporatist model of organizing the economy, where organized labor had much more power, and towards what we have now, which is the much more neoliberal model, which is one in which capital and finance capital in particular has much more power, and that was achieved through a set of policies and through a set of state interventions. So, for example, financial deregulation, privatization. In the UK, we obviously had a mass sell-off of social housing that contributed to the financialization of real estate that led up to the financial crisis of 2008. But a big part of that was about shifting who had power. And it stemmed, again, from a wider shift in the balance of power within society. If you look back at the New Deal itself, that wasn't just the American government saying, right, we're going to do a bunch of stuff that's going to kind of, augment the power of organized labor and constrain these big trusts and the power of finance. What happened was a real substantial increase in the power and the size of the labor movement, and a big social shift in favor of kind of constraining the power of monopolies and actually trying to regulate these things. The regulation that then came out of that reinforced that shift and built institutions around it. And you can see the same thing happening in the 1980s. So with that kind of big round of globalization that took place after the post-war period, and kind of supervised under the mantle of the Bretton Woods institutions that were all about constraining hot money flows around the world, and kind of, really supporting these models of national development and corporatism that facilitated those kind of Trente Glorieuses, the post-war consensus. That started to break down in the 1970s. You had the collapse of Bretton Woods when Nixon took the US off the gold peg, and you had all sorts of technological changes that made it much easier for money to move around the world, the rise of the multinational corporation, as well as changes in politics. And that shift in power, in turn, manifested itself in a number of policies. So in the rise of kind of the power of neoliberal economists, who then implemented policies from within the state that consolidated their power. And that was things like, in the UK, the Thatcher government went to war on the labour movement, used the police, used the power of the state to destroy, basically, the miners' strike, to destroy the labour movement in the UK, and to really just constrain and reduce any resistance to the introduction of this model. And then the creation of that model was, again, built around creating a particular kind of subjectivity, creating a particular kind of relationship between the individual and the state. And that was about reducing the social safety net, encouraging everyone to purchase their own housing, encouraging everyone to have private pensions, so that we have this model of asset-based welfare, where you are dependent upon yourself, your earnings, your assets, your savings. You can't rely upon a social safety net to catch you if you fall. And that, again, creates a very individualistic attitude that reinforces those social relationships that came out there. So these questions about power really come before these questions about policy. Who has the power now? And what kind of policies are they going to be able to introduce to reinforce and undergird their power? My argument for democratic socialism is really that the only way we are ever going to see a shift towards a more sustainable, democratic, and just economic model is if we have a reversal in that shift of power that we saw in the 1980s. If we basically have a return to a model in which ordinary people, in which workers, in which working people have much more control over all of our economic and social institutions. And that means everything from reviving the power of the labor movement through to democratizing the economy, So giving workers a say in companies, giving people a say in public services, in regulatory institutions, through to actually democratizing the state as well. So things like, having decentralization, having participatory budgeting, having ordinary people kind of actively involved in all the decisions that affect their lives. And this isn't just a kind of good in itself because we like democracy. This is actually the only real sustainable long-term way of building a base that will be capable of pushing through policies that are contrary to the interests of the wealthy and powerful. Because it is not in the interests of many wealthy and powerful corporations, particularly, for example, the fossil fuel companies that hold so much sway over policy making in so many democracies, to say, we want to have, taxes on fossil fuels, we want to have regulation, we want to have redistribution. So you need to build a social base to push those policies through.
Yeah, I find it interesting that you talk about power and the redistribution of power. So this morning we had Achim Hensen here, who is a co-founder of the Purpose Foundation, and this foundation actually helps firms that out of their own self-interest want to democratize how they are set up. So they want to give workers more of a say. They want to avoid being financialized and being having their purpose dictated by shareholders, right? So they actively seek out the help of this foundation to actually have workers participate more and try to push out those who have a purely financial interest in the business. So do you think that these sort of individual companies are enough of a motor for this type of idea, or do you think we really need much more of a let's say a political way to get there? So to really enforce this type of governance, basically.
Yeah, I mean, I think what we see in terms of companies shifting over to a more democratic model of corporate governance is encouraging and shows us that actually this can work. So one of the big arguments that you get in response to, well, we need to democratize the economy, we need to have worker and citizen participation, is that people don't know what they want, people don't understand their own interests, they don't understand what it's like to run and manage a company. But actually, when you look at the performance of many of these companies that are democratized and that do have a much kind of healthier balance between workers and management, they perform a lot better, and they're often more productive, they're more sustainable, they have lower turnover rates in terms of employees, and just they're much better places to work, and that happens without compromising the bottom line. So this is proof of concept. I think it's proof that this does actually work. Obviously, when you have this on the kind of micro level, it's quite difficult to scale up. And the reason that it's difficult to scale up is because ultimately these questions of power are, in the kind of economies in which we live, questions of ownership. And these questions of ownership are really central to determining corporate governance. I mean, if you look at the big shift that we had in corporate governance in the 1980s, which was a shift from a kind of I suppose a more kind of stakeholder model of capitalism towards this shareholder primacy, which is what we have today, where, basically it is Milton Friedman, the purpose of a company is to maximize its profits, and shareholder value is seen as a kind of accurate representation of the bottom line. And often that involves short-term profit maximization over long-term profit maximization. That wasn't simply an intellectual shift. It was, again, a shift in the balance of power. You had both kind of an increase in financial globalization. So it was much easier for money to move around the world with the collapse of Bretton Woods, with capital account liberalization. And that meant that, basically investors were able to kind of take their money out of companies, put their money into new companies. And also that you had a huge amount of capital available for things like corporate raiding and the kind of shakedowns and buyouts that you saw happen so much during the 1980s, such that those companies that weren't returning a huge amount to shareholders over the short term ended up just dying or being absorbed into something else. So you had a really big shift there in terms of, just the way the financial markets worked. And that was what shifted that corporate governance culture. Today, if we don't see a shift in the way that ownership operates, we're not going to see those values being kind of scaled up to the level of the whole economy. And I think one thing that's particularly interesting today is that there's a lot of arguments going around that we're moving away from this model of kind of short-termist shareholder value orientation back towards a model of stakeholder capitalism. And the reason for this is fascinating because it once again comes down to ownership. As we've seen a move from much more active investments to passive investment, basically. So whereby you have a bit, obviously today we have huge stocks of savings. That's your retirement savings. It's corporate profits. It's, often kind of sovereign wealth funds. And sorry, just one moment.
We're filming here. Are you
Yeah, I'm filming there and I have to do this too.
There's different studios here. So we're filming in these studios here. We can hear you all inside.
Right.
So if you're in some team, you need to be outside.
So perhaps let me use this quick interruption to encourage the students to ask your questions. You can either zoom in and ask them live here, or you can send us your questions. Don't worry, Grace. I use the opportunity to invite students to chime in and ask their questions. So don't worry about it. We're all good.
Great. So yeah, what I was just saying there was that you've had this shift in terms of ownership, whereby you've seen those funds that are being held as kind of savings, pension savings, etc., being moved to passive investment vehicles that are held by large asset managers. So you have three big asset managers that really kind of control a lot of those savings: BlackRock, Vanguard, and State Street. And together they hold just a massive amount of assets, a big stock of assets. And they own a huge amount of shares just across the economy. Because often what you're doing when you push your savings into these pots is you're investing in something along the lines of an ETF, exchange traded fund, which probably just tracks a particular index. So you might say, put your money in an ETF that tracks the S&P 500. And that means that you want your savings kind of equally distributed amongst all those companies in the S&P 500. And what that means is that the BlackRocks, the Vanguards of this world, have something along the lines of kind of 20% of the shares in the S&P 500. So they own about 20% of the shares in the S&P 500, which both gives them a huge amount of power, but also means that they're less interested potentially in kind of the individual returns being generated by one company and more interested in kind of returns across the whole economy. And this is giving rise to an argument actually in asset manager capitalism. These firms are much more concerned with long-term economic growth and kind of long-term returns. That is potentially quite an interesting development. But really what it depends upon is whether or not institutions like BlackRock and Vanguard and the big asset managers see the need to start to put pressure on the companies that they have large ownership stakes in to, for example, pay their workers properly, to introduce democratization into those companies, to decarbonize, and whether or not management will respond to that in the right way. At the moment, we haven't really seen much of that going on, but that change in ownership could actually lead to a much more substantial change over the long run.
Yes. So I'm perhaps this is actually what you were alluding to, and I didn't quite catch it. But I was wondering, we also see some instances of actually smaller organizations, smaller investors investing in companies actually with the goal of obtaining veto power and to influence basically the company strategy to become more sustainable and so on and so forth. This is, of course, something that could be a positive positive side of how ownership is structured, right? So do you see any more potential for this, or is this really like a side phenomenon that's not really gonna change much?
Yeah, I mean, I think this is, again, an interesting change. You saw, for example, I think a really interesting example of investor activism was the whole GameStop saga, right? So a bunch of small shareholders coming together online and saying, we want to push up the price of this particular share, partly in order just to screw over a bunch of hedge funds who'd taken short positions in those stocks. And for a while, it looked as though that was going to work. But ultimately, the institutional power of some of these, hedge funds and, indeed of actors within the financial system as a whole meant that there was a stop to trading, and it meant that these kind of small investors lost a lot of money. Some people lost lots and lots of money there. And I think that you often see this with kind of small shareholder activism, is that even when you get up to a critical mass that will be able to influence decision making, even when you get up to a critical mass that is able to influence valuations, you see vested interests within the system as a whole pushing back against that and saying, whether it's management saying, oh, actually, we're not going to listen to shareholder desires over executive pay, or whether it's regulators saying, we're going to put a stop to trading in this particular share. There are big, big limitations to small investors coming together and trying to use their voice in that way. But that isn't to say that there isn't the potential there for a different kind of model. So in my book, Stolen, for example, I argue that rather than, all our pension savings basically being passed on to an institution like BlackRock, which doesn't really have an incentive to act in the long-term interests of society, we could have a people's asset manager. So a democratically owned and governed institution that agglomerated savings in the economy, bought up ownership stakes in particular companies, and then used its power as a shareholder to say, we want to see you decarbonize. We want to see a smaller gap between average worker and executive pay, and put pressure on management to really shift the way that they were operating. And that could lead to a really systemic change in the way that these companies work. One thing that has happened literally over the last few days is that BlackRock has said that it wants to allow its clients, so investors basically who invest via BlackRock, to exercise their voice in how BlackRock is voting when it comes to shareholder meetings and things. And if that was pushed through, then that could be a real systematic change in the way that corporate governance works.
Yeah. Great. I just saw actually that we have a question from students. Oh, okay. It's not yet entirely ready, so I guess we're still having some technical issues. So perhaps in the meantime, I can ask another question. So you mentioned briefly the Green New Deal, and I've also seen that you're an activist for the English Labour Party. Now in Germany, we for the first time for a very long time, we actually have a situation where we might also end up having a Labour-led government. But, traditionally there's sort of a bit of a conflict between turning to a more green policy and the traditional voters of Labour parties who are in industries that are, have a, particularly a large carbon footprint. So I was wondering, how do you see potentials for reconciliation of these two of these conflicting interests?
Yeah, it's a really good question. And I think it basically comes down to this much wider question, which is which group in society is going to pay for the transition towards a green economy? Who is going to pay for decarbonisation? And we've seen, for example, in France with the Gilets jaunes protests, the attempt to kind of increase taxes. And, this would be the response, I think, in many countries with the attempt to introduce a big carbon tax that would be passed on basically to consumers and to workers. There was a lot of resistance to that. And I think unions often feel the same way in many countries, which is especially unions in the automotive sectors or in, fossil fuels or wherever, mining, that basically this green transition will result in them losing their jobs. And historically, given what we know has happened to workers in industries that have been shut down, and we saw this in the UK, for example, with the miners during the 1980s, they have not found new jobs. And that has led to structural unemployment in some parts of the country that lasted generations. Mm-hmm. So it's understandable, and it's, in many ways rational for these unions to say, well, in protecting the interests of our members, that means resisting this shift towards decarbonisation. But the response to that is not, I think, to say, well, these people are wrong and, they're wrong to care about their jobs. The response is to say, how are we going to have a just transition to net zero? And so that means this is really what the Green New Deal is all about. It's about making sure that, for every job lost in a dirty industry, not only is a job created in a green industry, but the training that is required to move people from one sector to the next is provided for free. And, any support that is needed in the transition from one sector to another is provided. And when the labour movement is comfortable with the fact that that will happen, you are much more likely to see compromise than you are to see conflict. And this was actually the case at the Labour Party conference in 2019, when there were some unions who were very uncomfortable, particularly those who worked in the car sector, in the automotive sector. They were very uncomfortable with the language of the Green New Deal because they were like, this is going to result in job losses for our members. But after a long kind of meeting where lots and lots of people were brought around the table, lots of the unions, lots of politicians, lots of activists, and it was really stressed that any funding that was going to be given to this decarbonisation project would involve a huge amount of money to go to reskilling, retraining, and really kind of delivering on this idea of a just transition. Mm-hmm. Then that motion was passed with the support of all of the unions. And that's really quite something, given the fact that, there are unions in there whose members would undoubtedly lose their jobs as a result of the Green New Deal, but who got behind it when this idea of the just transition was stressed. And we've seen this in other places as well. In, for example, Texas in the US, there is actually a movement among oil workers, among workers in oil refineries, to say, we want a Green New Deal. We want a just transition. We want to leave our jobs and be retrained and reskilled to get jobs in the green economy because, we want to leave a safer planet for our children. So there is a way to get around this. It's just about building coalitions and building power.
Great, thank you. So I think we're now ready to hear the question from our students or student.
Hello.
All right. Hi. Sorry. I am a huge fan of all your work. It's fantastic to have you here.
Thank you.
My question concerns the thing you talked about in reference to funding and paying for stuff. And as you've talked about Minsky, I wanted to inquire into your perspective on the role of private money creation and credit money creation in the economy. And as we always talk about Green New Deal and allocating funding, the question is, when we understand private credit money as a productive force itself, following Minsky, following Schumpeter, following Keynes itself, it's not so much a question of how, but rather of whether we want to and whether we allocate funding in the way it is. And then following that, your perspective on MMT I'd be very interested in that, like the role of state funding in that. So yeah.
Yeah, great question. You're basically right to say there that the question isn't how we pay for it in terms of how do we get the money. Money is obviously something that is created by public institutions like the central bank, and obviously by private institutions as well when they lend. And the big insight there, that again is something that isn't included in macroeconomic models, is that financial institutions aren't constrained by the amount of deposits that they hold in terms of their ability to create new money in the economy. So a bank doesn't have to wait to have money kind of in the bank in the form of deposits to be able to issue a loan. What determines whether or not they can issue new loans is demand for those loans and also regulation. So there is this massive power in the economy for financial institutions basically to be able to create new money. And in creating new money, they're basically deciding which resources are being used in which ways. And this power is even more evident when it comes to the central bank, which itself is able to create new banknotes, to create new electronic money. And we've seen this power used over the past several decades now, if you look back to where it started in Japan, to basically prop up asset prices through this process called quantitative easing, that many of you will have heard of, whereby central banks create new money and use that money to purchase assets from private investors. And what that has really done so far is again serve to kind of prop up asset prices, particularly government bonds, but also across the whole economy. So this is why we've seen in the US the longest bull run in history before this crisis. It's why we've seen house prices increase so much. It's basically because central banks have been pumping lots and lots and lots of money into private financial markets, and that money is trying to seek out somewhere to go. So currently that power of private finance and of public finance is being used in a very particular way. And it's being really used to support the interests of actors within the system already. So quantitative easing has served to boost asset prices, which has increased wealth inequality. It's been a big upwards redistribution, really, of wealth from some to others. And that's, again, a function of the kind of political relationships that exist within the heart of our financial system. A new way of thinking about this, or a different way of thinking about this, would be to say, right, well, we have this really substantial power, which is the power of money creation. How should we be using that? Should we be using it in the private interest or in the public interest? In the interest of a small number of powerful people, or to promote the kind of social good? And what I mentioned earlier about central banking, about the way that central banks have been using their power to create money to purchase assets, and they haven't really been paying attention, although this is starting to shift, they haven't really been paying attention to the environmental and social impact of the companies that they're technically investing in. That shifting that would be a really substantial change. So saying to central banks, you can only purchase assets in companies that meet these criteria. But much more broadly, thinking about how we change this across the economy, the big change there would be what I talked about in terms of public finance. So rather than kind of only allowing financial institutions to create new money and issue credit, could we have a public banking system, a public investment banking system, a public commercial and retail banking system that provided, say, low interest loans to small businesses that were operating in deprived areas, and a national investment bank that was able to channel that lending into the green economy? Those would be really, really big shifts that would really allow us to take control of this power over public finance and use it in the public good. MMT obviously is, it's a theory, it's a group of policy recommendations that stems from this insight that private financial institutions have this power over money creation. The issues that I have around MMT are that there is often a failure to incorporate these ideas around power into the theory of change. So once you realize that, private financial institutions have this power of money creation, that, the central bank has this power of money creation, it's then easy to say, right, well, all we need to do is, let's say, one of the recommendations that we have is that rather than having kind of quantitative easing that works in the interests of a small number of people, we have people's quantitative easing. So just, central banks creating money and using that to finance government spending. And the issue there is that, firstly, we need to think about how we build power to make those policies happen. And secondly, we need to think about the political implications of those policies, right? So it's not just about having a technocratic fix that will kind of, change one particular element of the public finances. It's actually about thinking how we provide the political and social foundations for that shift. And the problem I have with MMT is less the analysis. It's more the idea that, once you realize that this is the way that money works and you convince everyone of that, then society will change. Whereas actually the problem isn't that people don't realize this. The problem is that they don't have the incentive to act in such a way as to make it different.
Thank you. Does that answer your question?
Yes, sure. Fantastic.
Okay.
Love to hear that.
Great. Thank you so much for the question. And thank you, Grace, for the answer. Perhaps we can use our remaining minutes that we have to actually talk a little bit about your second book also, which is called The Corona Crash, How the Pandemic Will Change Capitalism. So, I mean, I guess it's a bit too optimistic for a few minutes, but what do you think, Grace, actually? How will it change? How will it change capitalism?
Big question. I guess I'll talk about a couple of changes that I've noticed and written about in the book. One is inequality. Now, this, we know that in the past, pandemics tend to increase inequality. This one is going to have a really, really big impact on inequality. And you can see this through the savings ratio. So for a very long time, the savings ratio in most OECD countries is broadly flat. And then during the pandemic, it goes up, it spikes dramatically. And the reason for this is that people have fewer outlets to spend disposable income. So for those people who've kept their jobs, been able to work from home, they've put a lot more money aside in the form of savings. And because of what we've had in terms of central bank asset purchases that are, boosting asset prices, when those savings have been invested in financial markets or when they've been invested in, say, housing, they've often increased in value. So some people have become very, very wealthy over the course of just the last few years from investing excess savings. Those who haven't been able to accrue savings, so those who've lost their jobs or those who've, not had the same reduction in costs that the wealthier might have had, some of them have actually fallen further into debt. So they've been dis-saving, as it were, and others have just kind of stayed flat. So that difference between those who have assets and are able to invest them and those who don't is really becoming very, very big and very, very important. And that is, I think, going to be the defining battle of the post-pandemic age, is going to be what happens to all of those savings. So how are they invested? Are they taxed? And what happens to those people who haven't been able to accrue savings? Because once you start getting a big private stock of savings, I mean, it has implications for the way the financial system works that we're already seeing, but also has implications for the balance of power within wider society and our institutions as a whole, because it becomes much easier to say, well, we're actually not going to have public services. We're not going to have, social housing, because 50-ish% of people have enough savings to be able to insure themselves against risks that might take place across the life course. So those who don't have those savings, well, it's not really our responsibility to deal with them, because that might require us to kind of tax those people who do have those savings. So that battle between people who have assets and people who don't is going to become much more entrenched. The second trend is going to be market concentration and monopoly power. And this always happens during crises, because smaller firms that are less resilient, that have weaker links with their financial backers, weaker links with the state, they tend to go under. More powerful institutions that have close political connections, that have powerful banks behind them, and just have higher margins, they're able to survive and actually grow. And we've seen this over the course of the pandemic with, we have now an unparalleled, unprecedented level of market concentration in some sectors where, in the US, for example, it is 5 companies are responsible for over a fifth of the value of the entire S&P 500. That is an unprecedented level of market concentration. And that's predominantly in big tech. And we've seen this with Amazon, for example, just generating astonishing increases in share prices. And partly that increase in the share price reflects the fact that Amazon is this company that has a desire to become the everything store, whose business model is built on basic.
Have we lost our connection? It seems so. That is too bad. Do you reckon we will be able to reinstate it, or? Okay, does it make sense to try to reconnect, or shall we close it at this point? Okay. So, too bad that I can't thank Grace in person anymore for her very interesting insights. I think she would have had a lot more to say on how the corona pandemic will change capitalism and whether to be hopeful or not, and what to expect. But I think looking at the book is a good substitute, even though I think that this one is not available yet in German. You can buy the English version, obviously not of Amazon. And yeah, I hope you enjoyed this talk. I think these were very interesting insights, and this was the last of the talks in this year's opening week. And I hope you can take some inspiration from it for the remaining days and for the rest of your studies.